Hello and welcome to the March edition of my market newsletter. I just keep finding there's an abundance of noise and confusion in the financial markets, and that most Americans just don't know how to cut through the noise and get the data they're really looking for to be able to make informed decisions. Because of this, I created a newsletter. Each month I put together a summary of thinkings to be able to help educate long-term decisions. Additionally, I have a couple disclosures. Because of the increased regulation and compliance in my industry, I need to start with saying everything in this newsletter is based on my opinion. It's not predictive in any way. Additionally, I've used AI to help assist in rewriting my newsletter to reduce grammatical errors and to improve syntax. So, if you've turned on the news recently, you likely have a familiar tightening in your chest, really between the escalating conflict in Iran and the lingering aftershocks of last year's tariff typhoon. At least that's what I'm calling it. It feels as though we are living through a period of uniquely high uncertainty. The headlines suggest that the world is more volatile than ever, and that there's this temptation that you have to do something to be able to protect your hard-earned capital. I just keep finding this reaches a fever pitch. Now, because of this, I want to remind everyone, uncertainty in the investing markets, I don't see this being a temporary bug in the investment landscape. I see this being a permanent feature of successful investing. So let me explain. There's a term, principled consistency. It can be a tagline, sure. I don't find it to just be a tagline. I see this as being a recognition that while we cannot control the world, we can control our reaction to it. And so to help navigate these headlines, I've distilled a framework of some information, followed by a deeper look at how history and risk actually function for us. So, stay with me as we get through this. First up, I do want to cite, there's an article, if you look at my full newsletter, there's an article written by Ben Carlson called The 10 Rules for Dealing with Uncertainty. What I have here is just a summary of these 10 rules down to roughly 4. Now, the first one is going to be focus on the controllables, right? This one's simple, but the reality is you and I cannot control the Fed. We cannot control what's happening in Iran. Global trade policy, etc. However, you do have total control of your savings rate. You do have control over the asset allocation, and most importantly, your behavior. In an uncertain world, your behavior is your greatest asset. It's also your greatest liability. Now, the next is discipline over optimization. You don't need a complex or perfect, good luck finding that, perfect portfolio to reach your goals. What you need is a plan that you can actually stick with when things get uncomfortable. The most sophisticated answer is often the simplest plan. Now, the nature of risk, true risk is rarely the headline everyone is already talking about, which really likely the market has already priced in. Real risk that I see is the unknown unknowns. No one sees coming because the future is inherently unpredictable. Doing nothing can sometimes be, not always, but oftentimes can be an informed, disciplined decision. And the last, kind of like a summary point here is to be able to maintain constructive criticism. It's healthy, and I encourage you and everyone to be skeptical of sensational predictions. I would say avoid cynicism. Cynicism leads us to believe that progress has stopped. Well, that's a bet that has been wrong for centuries. All right, now, thinking of why this time is different, or maybe why this time is never different. This is often common. People, what I would say, fear-mongering, saying, hey, this time is different, right? And that we tend to view historical investing like a smooth, inevitable, upward line. And on this chart I'm going to share here is really looking at just all the different points that have happened. Here, I'll get myself out of the way, right? All types of different points from 1970, right? There's an overload of data that we all have access to. I find most of that, are from companies that are paid to get clicks, right? So these financial media headlines, the more tantalizing the headline, a lot of times the more clicks they get, right? In reality and historically, every period of significant growth was punctuated by existential crises that felt us, that left us feeling like we're in a dire position. Just study the chart. Find one that sticks out to you, right? Something that sticks out to me is at 1973, right? I know it's small, but here, there's a market peak, right? This is the Arab oil embargo, caused prices to quadruple, And then the Watergate scandal that paralyzed the government. People weren't thinking, hey, this is a great buying opportunity. They thought the American experiment was over. And then after that, we had the dot-com bubble burst. We had the trauma of 9/11. And at the prevailing wisdom of the time of buy and hold, people thought the idea was dead. And then, of course, we had the 2008 financial collapse. And the fear wasn't just a market drop. It was a total destruction of the global financial and banking system. Yet, I'd say, despite these existential threats, shareholder capitalism remained intact. Well, why? Well, because the great companies that we invest in do not sit idly by just during a crisis. They do what any rational person would do. They cut costs, they innovate, they acquire weaker competitors, and they find ways to provide value in a changing world. Here's a cool part. Right, the math of just staying invested is staggering. $100,000 invested in the S&P 500 in January 1973 at the very start of the decade of stagflation, oil shocks, and political crisis would have grown to over 24.7 million by the end of 2025. That's a compounded annual growth rate of 10.9%. The source on this is back on my website, right? Through 53 years of uncertainty. What this is saying is that history proves that global economic advances, when you step back and think about it, it seems that innovation is birthed from chaos. We'll see. Okay. A couple other points here I want to make. This one has to do with volatility versus real risk. Okay. So as your advisor, one of my most important jobs is to be able to help us all distinguish between market noise and actual risk. I find it's common to mistake volatility for risk. Volatility is a temporary decline of account balances during a market correction. For example, last year, almost 12 months ago, the 21% drop we saw in the tariff typhoon of 2025. That's volatility. It's uncomfortable. But it is not a loss unless we sell. It's simply, sometimes, or what I call the price of admission. The market charges for long-term returns. But I see the real risk is the one that we all should actually fear. It's the permanent erosion of our purchasing power. This is the risk that money loses the ability to buy goods and services we need to live our current lifestyle. This is simply understood as keeping up with, but then excelling past inflation in an after-tax manner. Also, I can show you a chart from the New York University Stern School of Business, I think, which shows between stocks, bonds, cash, gold, real estate, there's only one singular asset class that historically outpaces inflation. Stocks. Okay, now, I will tell you that there's like a trap of safety, right? When headlines get scary, most of us, including myself, feel like, oh, I need to go to cash to keep myself safe, right? Now, another data point here, I call compounding income. Consider the growth of dividends in 1996, 30 years ago, right? The cash dividends of the S&P 500 was $13.98. February 2026, 30 years later, it rose to just shy of $80, right? That's an increase of 420%. And during that same period, consumer prices only ruffled double. Only doubled. Now, you didn't ask it, but I'll share anyway. If you invested that same $100,000 in 96, last month you would have had just shy of $2 million. Now, when you own a diversified portfolio of global equities, if you work with me, you do, you aren't just betting on stocks. The way I see it is you own a share of companies that are transparent, audited, motivated to make you money, the shareholder. And these companies have a history of raising their share prices and growing their earnings faster than inflation, protecting your family's standard of living in a way that, like cash, safe cash assets, historically just haven't been able to, right? And that my goal, right, is for everyone to be able to work towards a peace of mind. The world isn't certain, right? Your plan is built to withstand uncertainty. The way I think about it is that money is a tool, something to be acted upon to be able to accomplish your goals. Of course, I don't pretend to have a secret formula. There's no crystal ball that can predict the outcome in Iran or the next market swing. What I do have is a process designated to try and create consistent personal outcomes by adhering to the principles that have worked for over a century. Now, if the current environment has you feeling anxious about your financial plan or financial blueprint, let's just be sure to schedule a call, right? You don't need to feel that way. Let's just be sure to talk through it. Okay, now from there I am going to transition into this additional data section. Each month I put together just some things I'm looking at. This is not indicative or predictive of any way, just a couple data points I think are interesting. The first up is looking at, again, get myself out of the way. First up is looking at global returns. Okay, this is really answering the question I get every once in a while. Why should I own anything other than the S&P 500? Well, that's one of the most common questions I get, and this is a rather compelling chart, right? So you can see over this period of time, I wouldn't have known unless I saw it here. South Korea is up 200%. Peru's up 142%. Now, keep in mind, South Korea, this index is heavy Samsung, and there's one other company that's escaping me right now. But you get the point on this, right? Emerging markets up 50%, Euro up 50%. U.S. hasn't done bad, 28%. Or sorry, total world, 28%. U.S. up 18%. But it's interesting, when you look at, the bottom quartile, right? The U.S. is definitely in it. That's new for us. Now, this does not mean we should go all in on South Korea. This is simply just a data point. This is why it's so important that we have a globally diversified portfolio. All right, the next chart is one that everyone has seen multiple times. Let me make this bigger, actually. These are the market swings, right? For each year, we're looking at, for example, the market was down in 2025, 19%, finished the year plus 18%. I'm guilty of putting this in here a lot. I'm just continually surprised, right? And just wowed at the nature of this chart. How far the market goes down each year, typically. How high it's recovered, historically. Got it. All right, 2 more data points. One's going to be continuing to look at inflation. I'm kind of tired of tracking this, I will be honest. Looking at this every month for the past 5 years, but it just continues to be important, I find. The next 5-year break-even point being 2.4%. And the last data point here is, I think, of course, this is a big problem that our politicians just don't seem to want to address. I hear them talking about it. I don't see a lot of action with it. It's federal debt and the interest payments. We're at about $1.2 trillion a year. I do hope that debt comes down. I do hope that debt as a percentage of spending, GDP, comes down. We shall see. So, of course, in closing, we cannot control what the market does from here. And, of course, we cannot predict when the next market downturn will be, right? What we can control is our behavior to these outside events. So, as always, thank you for your trust. If you have any questions at all, please don't hesitate to reach out. Thank you. Talk soon.